The silver you can buy today costs less in nominal terms than it did 46 years ago. That's not an investment opinion. That's a mathematical fact that violates every principle of monetary inflation and commodity scarcity. In January 1980, silver reached $49.45 per ounce during the Hunt Brothers squeeze. As of February 5th, 2026, silver trades at $31.85 per ounce on the COMEX futures exchange in New York. That represents a 35.6% decline in nominal terms from the 1980 peak. But the suppression becomes starkly visible when adjusted for inflation. Using the consumer price index, that $49.45 in 1980 dollars equals $194.30 in February 2026 purchasing power. Silver is currently trading 83.6% below its inflation-adjusted historical high. Meanwhile, every other major asset class and economic measure has multiplied over the same period. The S&P 500 index has risen approximately 5,200% since January 1980. Gold has increased 720% from its 1980 peak of $850 to current levels near $2,220 per ounce. Crude oil has risen over 400% from its 1980 average. The U.S. M2 money supply has expanded by 2,140% over the past 46 years, reflecting massive monetary expansion. Real estate, equities, bonds, and virtually every store of value has appreciated dramatically in nominal terms. Yet silver, a metal with demonstrably finite geological supply, an exponentially growing industrial demand in solar photovoltaic panels, electric vehicle components, 5G infrastructure, and advanced electronics manufacturing, remains profoundly suppressed relative to both its historical price and its fundamental supply-demand dynamics. This price suppression at this magnitude and duration has appeared only twice in modern commodity market history. First with gold during the London Gold Pool operation from 1961 to 1968, and second with crude oil during the coordinated OPEC surplus production strategy throughout the 1990s. Both interventions eventually failed catastrophically, resulting in price explosions that caught markets completely unprepared. So here's the question that demands examination. If silver's structural supply-demand fundamentals unambiguously suggest prices should be multiples of current levels, and if the divergence between paper futures pricing and physical metal scarcity continues widening with each passing month, what specific mechanism is holding the price down? And what happens to markets, institutions, and investors when that mechanism inevitably breaks? I'm Johnny G, and this is Histo Finance. Between January 20th and February 3rd, 2026, a critical divergence emerged in the silver market that exposes the structural fragility of Western price discovery mechanisms. On the COMEX futures exchange in New York, silver traded in a relatively narrow range between $31.40 and $32.60 per ounce during this 2-week period. Volume was moderate, volatility was contained, and the futures market appeared to function normally by conventional metrics. But simultaneously, in the physical silver market where actual metal changes hands, a completely different reality was unfolding. Physical silver premiums, the amount buyers must pay above the COMEX spot price to obtain actual coins or bars, exploded to levels not witnessed since the March 2020 pandemic shortage, and the 2011 run to $49. U.S. mint-issued American Silver Eagles, which typically trade at $3 to $4 per ounce over the COMEX spot price during normal market conditions, were selling for $9.80 to $12.50 over spot at major online dealers and local coin shops as of early February 2026. That represents a premium range of 31% to 39% above the paper futures price. Canadian silver maple leafs, another popular government-minted coin, showed premiums ranging from $8.40 to $10.90 per ounce over spot. Even generic silver rounds from private mints, which normally trade closest to spot prices, were commanding premiums of $5.20 to $7.10 per ounce. This is not a temporary dealer markup issue or a localized supply problem. This represents a fundamental supply constraint across the entire North American physical silver distribution network. Dealers are paying $1.50 to $2.20 per ounce over COMEX spot prices to acquire inventory from the public through buyback programs, and even at those elevated wholesale acquisition costs, they still cannot source enough physical metal to meet retail customer demand. The bid-ask spreads have widened dramatically, and inventory turnover times have extended from the normal 3 to 7 days to 14-21 days in many markets. The United States Mint, which operates the world's most prominent sovereign coin program, sold 4.12 million American Silver Eagles in January 2026 alone. That represents the highest January sales total since January 2013, when the Mint sold 7.4 million Eagles during the height of the post-2008 financial crisis precious metals boom. Despite operating production facilities at maximum rated capacity with extended shifts and weekend operations, the Mint has been unable to fulfill dealer allocation requests. Since mid-December 2025, the Mint has implemented a strict rationing system where authorized dealers receive only 55% to 65% of their requested monthly Silver Eagle inventory. This rationing has been in continuous effect for over 7 weeks, forcing dealers to implement purchase limits for retail customers and prioritize long-standing relationships over new buyers. COMEX delivery data reveals the underlying physical stress in the professional market. During January 2026, total silver deliveries against expiring futures contracts reached 9.8 million ounces, significantly above the 12-month rolling average of 5.4 million ounces. This represents an 81% increase in delivery activity compared to the recent historical norm, but the critical data point is what happened to registered inventories during this same period. Registered inventories, the specific category of silver held in COMEX-approved warehouses that is available for immediate delivery against futures contracts, declined from 41.8 million ounces on January 1st, 2026, to just 34.2 million ounces by February 3rd. That represents a drawdown of 7.6 million ounces in just 34 calendar days, an 18.2% decline in deliverable inventory in barely more than a month. If this drawdown rate continues linearly, registered COMEX silver inventories will fall below 20 million ounces by June 2026 and approach functionally critical levels by the fourth quarter. While the exchange will certainly intervene before inventories reach zero, the trajectory indicates unsustainable pressure on the physical backing of the paper futures market. The leverage in the system becomes apparent when examining open interest data. As of February 3rd, 2026, total COMEX silver open interest stood at 176,800 contracts. Since each standard COMEX silver contract represents 5,000 troy ounces, this translates to 884 million ounces of silver, represented by outstanding paper contracts. With only 34.2 million ounces in registered inventory available for delivery, the ratio of paper claims to deliverable physical metal stands at 25.8 to 1. This means that for every single ounce of silver actually available for immediate delivery in COMEX warehouses, there exist 25.8 ounces worth of paper contractual claims. This ratio has expanded dramatically from 19 to 1 in January 2024, demonstrating accelerating leverage and growing fragility in the pricing mechanism. Internationally, the divergence between paper and physical is even more pronounced. On the Shanghai Gold Exchange, the primary precious metals trading venue in China, physical silver has been trading at a premium of $2.15 to $2.85 per ounce above equivalent COMEX futures prices throughout January 2026. This premium, known in the industry as the Shanghai Premium, reflects the willingness of Chinese industrial users, investors, and speculators to pay substantially more for guaranteed physical delivery than the Western paper futures price suggests the metal is worth. For historical context, this Shanghai Premium averaged just 0.40 to 0.70 per ounce from 2019 through 2023. The current premium represents a 400% to 600% increase, indicating that Eastern physical buyers are now paying 4 to 6 times the historical premium differential to secure actual metal. The appearance of backwardation in the futures curve provides additional technical evidence of physical market stress. On January 31st, 2026, the March 2026 silver futures contract briefly traded at a higher price than the May 2026 contract, a market condition known as backwardation. In a normally functioning commodity market, futures prices are higher than spot prices due to the carrying costs of storage, insurance, and the time value of money. When this relationship inverts and near-term contracts trade at a premium to deferred contracts, it signals that immediate physical demand exceeds readily available supply, and buyers are willing to pay more for metal today than for a promise of metal months in the future. Backwardation in silver is a rare phenomenon that has appeared at only 3 significant moments in modern market history. March 2020, during the initial pandemic supply chain disruption, April 2011, in the weeks before silver peaked near $49, and January 1980, during the climax of the Hunt brothers' accumulation campaign. In each historical instance, the appearance of backwardation preceded significant and rapid price movements in the physical silver market. System mechanics. To understand where and how the pricing system is breaking down, you must first understand how silver price discovery is designed to function under normal market conditions, and where the potential points of intervention and manipulation exist within that structure. Silver is priced globally through 2 primary mechanisms that are supposed to operate in coordinated equilibrium. The COMEX Futures Exchange in New York and the London over-the-counter physical market operated by the London Bullion Market Association. The COMEX is a regulated derivatives exchange where standardized futures contracts for silver delivery are traded electronically and through open outcry. These contracts specify delivery of 5,000 troy ounces of silver of specific purity standards to approved warehouse facilities. The London OTC market is where large physical bars, typically 1,000-ounce bars meeting specific refining and assay standards, change hands directly between commercial banks, bullion banks, refiners, and large institutional participants. Both markets theoretically reflect the underlying supply and demand dynamics for physical silver, with price differences between venues kept narrow through arbitrage activity. Arbitrage is the mechanism supposed to maintain pricing consistency across markets. If COMEX futures trade at a premium to London physical spot prices, arbitrageurs should theoretically buy silver in London and simultaneously sell COMEX futures contracts, capturing the price spread as risk-free profit. This arbitrage activity, buying in the cheaper market and selling in the more expensive market, should force prices to converge until the spread narrows to merely the transaction costs and logistics expenses of moving physical metal between markets. Conversely, if physical premiums rise significantly above futures prices, arbitrageurs should theoretically buy futures contracts, take physical delivery, and sell the metal in the physical market at the elevated premium. However, this arbitrage mechanism depends critically on three underlying conditions that must remain functional: sufficient available physical supply to source when needed, functioning logistics and refining infrastructure to process and transport metal, and most importantly, the willingness and ability of futures contract short sellers to actually deliver physical metal when contracts are exercised for delivery rather than cash settled. All three of these foundational conditions are currently breaking down simultaneously, starting with physical supply constraints. Global primary silver mine production has been essentially stagnant, ranging between 820 and 850 million troy ounces annually since 2017, despite silver prices rising from $14 in early 2020 to current levels above $31. Mine production has not responded with increased output. This is partly because approximately 70% of mined silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Silver production is therefore constrained by the economics of these primary metals rather than responding directly to silver prices. Meanwhile, industrial demand for silver has exploded. Total industrial consumption grew from 535 million ounces in 2020 to an estimated 748 million ounces in 2025, representing a 40% increase in just 5 years. This growth is driven primarily by three sectors: solar photovoltaic panel manufacturing, which consumed approximately 183 million ounces in 2025, compared to just 105 million ounces in 2020. Electric vehicle electronics and battery technologies, which required 71 million ounces in 2025 versus 52 million in 2020. And 5G telecommunications. Infrastructure and advanced electronics manufacturing, which consumed 261 million ounces. These industrial uses are largely price inelastic. Manufacturers cannot simply substitute other materials without expensive redesigns and performance compromises. Investment demand added another 284 million ounces in 2025 through purchases of coins, bars, and ETF accumulation. When industrial and investment demand are combined with other uses, including jewelry and silverware, total global silver demand reached approximately 1.14 billion ounces in 2025. Compare this to total supply from mining and recycling of approximately 1.06 billion ounces, producing a structural deficit of roughly 80 million ounces. This deficit must be filled by drawing down above-ground inventories, the existing stockpiles held in warehouses, vaults, and exchange depositories. The logistics and refining bottleneck compounds the supply problem. Physical silver must be refined to 1,900/199 or 9999 purity standards to meet exchange delivery specifications. This refining process requires 30 to 45 days under normal operating conditions. Transportation from refineries to approved vault facilities adds another 15 to 30 days depending on origin and destination locations. The global refining industry currently operates at 97% to 99% of maximum rated capacity, with minimal spare capacity to absorb sudden demand surges. This creates a 45 to 75 day lag between initiating arbitrage and actually receiving deliverable metal, during which market prices can move substantially, introducing significant risk to the arbitrage trade. But the most critical failure point in the system, and the mechanism through which price suppression operates, is the cash settlement structure of COMEX futures contracts. Approximately 98% of all COMEX silver futures contracts are settled in cash rather than through physical delivery of metal. Only about 2% of contracts actually result in physical silver changing hands. The vast majority of market participants are either speculators seeking price exposure without any intention of taking delivery, or hedgers managing price risk in underlying businesses. This cash settlement structure allows the price to be set by a paper market that has only tenuous connection to physical supply constraints. As long as most participants are willing to accept cash settlement, the market can continue functioning even when paper claims vastly exceed physical availability. The price is determined by the trading activity of participants who never intend to demand physical metal, This creates the structural opportunity for price suppression through concentrated short selling. If a small number of large commercial participants, typically major commercial and bullion banks acting as market makers, hold massive short positions and consistently supply futures contracts to meet any level of buying pressure, they can effectively cap price increases regardless of physical market fundamentals. These shorts don't need to own the physical metal to sell the contracts. They simply need sufficient capital and institutional backing to maintain margin requirements. According to the most recent Commitment of Traders report published by the CFTC on January 28, 2026, commercial traders held net short positions equivalent to approximately 447 million ounces of silver. This represents 102% more than the total registered COMEX inventory available for delivery. The four largest commercial short position holders, their identities are not publicly disclosed but are widely believed to be major money center banks, control approximately 64% of total commercial short positions, equal to roughly 286 million ounces. This concentration has increased from 58% in 2023, indicating growing concentration of short interest among fewer participants. This concentrated short position structure creates several categories of trapped participants. Industrial users who require physical silver for manufacturing are price takers. They must purchase metal at prevailing prices regardless of whether those prices reflect true physical scarcity. When physical premiums spike 30-40% above futures prices, industrial users face margin compression as their input costs exceed what futures prices suggested they would pay. Investors holding paper silver through unallocated ETFs or bank accounts own claims on metal that may not be fully backed by segregated, identified physical inventory. If redemption requests surge and the fund or institution must source physical metal at 30-40% premiums above the stated net asset value, either the fund faces catastrophic losses or redemptions must be suspended or settled in cash at prices that don't reflect physical reality. Miners who produce silver from the ground sell their output at spot prices, often locking in prices months in advance through forward sales and hedging contracts. When physical premiums spike dramatically, miners do not capture this premium. Intermediaries, refiners, and dealers do. The miner's revenue remains tied to the suppressed futures price, while their costs for energy, labor, and equipment continue rising with general inflation. The commercial banks holding massive concentrated short positions face the most severe trap. If physical delivery pressure increases substantially, for example, if even 10% of open interest contracts stood for delivery rather than the normal 2%, these banks would need to source approximately 88 million ounces of physical silver in a market where only 34 million ounces are readily available in registered inventory. They would be forced to enter the physical market and bid prices up dramatically to source metal, likely paying 30-50% premiums. This would generate enormous losses on their short positions and potentially trigger a cascade of short covering that drives prices exponentially higher in a feedback loop. This is the structural fragility at the heart of the silver market. A paper pricing mechanism operating at over 25-to-1 leverage, where a small number of concentrated short sellers can suppress prices as long as physical delivery demands remain minimal, but where any significant increase in delivery requests could trigger a catastrophic short squeeze and price dislocation. The suppression becomes mathematically undeniable when examining inflation-adjusted price performance. Silver's January 1980 peak of $49.45 per ounce, when adjusted for consumer price index inflation through February 2026, equals $194.30 in current purchasing power. The current COMEX price of $31.85 represents an 83.6% decline from this inflation-adjusted historical high. This means silver has lost more than 4/5 of its real purchasing power over 46 years, despite being a finite physical commodity with growing industrial consumption. Compare this to gold's inflation-adjusted performance. Gold peaked at $850 per ounce in January 1980, equivalent to $3,340 in February 2026 dollars. Gold currently trades near $2,820, representing just a 15.6% decline from its inflation-adjusted peak. Silver has underperformed gold's inflation-adjusted recovery by a staggering 68 percentage points. This divergence is statistically anomalous, given that both precious metals respond to identical macroeconomic drivers, including monetary expansion, currency debasement, inflation expectations, and safe haven demand during financial instability. The gold-to-silver ratio quantifies silver's relative undervaluation. As of February 5, 2026, this ratio stands at 88.6-to-1, meaning it requires 88.6 ounces of silver to purchase 1 ounce of gold. The historical average over the past 100 years is approximately 62-to-1. The geological ratio, reflecting how much silver is actually mined relative to gold from the earth, is approximately 8-to-1. At the current ratio of 88.6-to-1, Silver is undervalued by roughly 30% relative to its historical average relationship with gold, or by an extraordinary 91% relative to the geological mining ratio. If the ratio were to revert to the 100-year historical average of 62 to 1 with gold at its current price of $2,220, silver would trade at $45.48 per ounce, a 43% increase from current levels. If the ratio were to revert all the way to the geological ratio of 8 to 1, which prevailed during most of the 19th century when both metals circulated as money, silver would trade at $352.50 per ounce, a more than 1,000% increase. The leverage explosion in the futures market reveals growing fragility. Current open interest of 176 800 contracts represents 884 million ounces in paper claims. With registered inventory of just 34.2 million ounces, only 3.9% of open interest is backed by immediately deliverable physical metal. The leverage ratio of 25.8 to 1 compares to just 12 to 1 in 2016, representing a 115% increase in paper claims relative to physical backing over the past decade. This is the definition of a fractional reserve commodity market where the paper claims have become increasingly divorced from physical reality. Physical premium data confirms the paper-physical disconnect. The average premium for American Silver Eagles from 2016 through 2020 was $2.30 per ounce. The January 2026 average premium was $10.85, representing a 372% increase. Generic silver round premiums averaged $0.95 from 2016 and 2020, but reached $5.90 in January 2026, a 521% increase. These premiums above $8 for Eagles have now persisted continuously since April 2024, indicating 22 consecutive months of sustained physical tightness, far beyond any temporary supply disruption. COMEX delivery activity versus inventory drawdowns exposes the system consuming its own reserves. Total 2025 deliveries reached 76.3 million ounces, while registered inventory declined by 16.8 million ounces over the same period. This means that 22% of delivered silver came from inventory drawdowns, rather than from new supply entering the system. The market is effectively eating its seed corn. If this 22% drawdown rate continues, registered inventory would reach zero by the fourth quarter of 2027, though the exchange would almost certainly intervene before reaching that point. Industrial demand growth vastly outpaces mine supply growth. 2025 mine production reached 827 million ounces, representing just 0.8% growth from 2024. Meanwhile, solar panel silver demand grew 16.5% to 183 million ounces. Electric vehicle demand surged 24.6% to 71 million ounces, and electronics consumption increased 4.2% to 261 million ounces. Industrial demand in high-growth technology sectors is expanding at 9 to 14% annually, while mine supply grows at under 1% annually. This gap must be filled by recycling, but recycling added 218 million ounces in 2025, and the scrap pool is fundamentally finite and shrinking as older electronics and photographic materials are exhausted. The concentration of short positions creates systemic risk. The four largest commercial shorts hold 286 million ounces, representing 64% of all commercial short positions. This concentration has increased from 54% in 2021, indicating growing position concentration among fewer entities, almost certainly major commercial and bullion banks. If any one of these four large shorts faces financial stress, regulatory pressure, or a risk management decision to reduce position size, the resulting buy to cover activity would overwhelm available supply and potentially trigger forced covering by the other concentrated shorts in a cascading squeeze. The pattern of sustained price suppression through institutional intervention, followed by catastrophic failure and violent price adjustment, has occurred twice in modern commodity market history, providing clear precedents for the current silver situation. The London Gold Pool operated from 1961 to 1968 as a coordinated effort to suppress gold prices and maintain the Bretton Woods system of fixed exchange rates. Under Bretton Woods, established in 1944, the US dollar was fixed at $35 per troy ounce of gold, and other currencies were pegged to the dollar. This system required maintaining gold at $35 to preserve dollar credibility in the international monetary order. However, as the United States dramatically expanded its money supply throughout the 1960s to finance both the Vietnam War and President Johnson's Great Society domestic spending programs, demand for gold at the fixed $35 price far exceeded available supply. To prevent the price from rising and potentially breaking the Bretton Woods system, the United States and 7 European central banks, the United Kingdom, West Germany, France, Switzerland, Italy, Belgium, and the Netherlands formed the London Gold Pool in 1961. These 8 central banks agreed to sell gold from their official reserves into the London market whenever buying pressure threatened to push the price above $35.20 per ounce. Over the 7-year life of the pool, participating central banks sold approximately 3,000 metric tons of gold to suppress the price and maintain the fixed peg. For several years, this intervention successfully held the price despite growing structural deficits between supply and demand at the fixed price, but the fundamental imbalance persisted and ultimately proved insurmountable. In March 1968, a massive surge in private gold buying overwhelmed the pool's capacity to supply metal. In a 2-week period, the pool was forced to sell over 1,000 tons, 1/3 of their total 7-year sales, to defend the $35 price. On March 17, 1968, the pool acknowledged defeat and was formally dissolved. The official gold price for central bank transactions remained at $35, but private markets were allowed to trade freely. By August 1971, the dollar's convertibility to gold was completely suspended by President Nixon, ending the Bretton Woods system entirely. Gold, finally free from artificial suppression, rose from $35 in 1968 to $850 by January 1980, a staggering 2,329% gain over just 12 years. The mechanism was identical to current silver market structure, a consortium of large, well-funded institutions with capacity to supply physical metal intervened systematically to hold the price below the level that supply and demand fundamentals indicated. The intervention successfully suppressed price for years, but the structural deficit between supply at the fixed price and demand at that price could not be eliminated through intervention alone. When the suppressing institutions exhausted their willingness or capacity to continue supplying, the price adjusted violently and rapidly to reflect the cumulative imbalance. The second clear precedent is the Hunt brothers' silver squeeze of 1979 to 1980. Throughout the 1970s, silver traded in a relatively narrow range between $4 and $6 per ounce, despite accelerating inflation and dramatic currency debasement. Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires, became convinced during this period that silver was artificially suppressed and represented extraordinary value. Beginning in 1973, they initiated a systematic accumulation program, purchasing physical silver and taking delivery of COMEX futures contracts to remove metal from exchange warehouses. By 1979, the Hunt brothers and their associated entities controlled over 100 million ounces of physical silver. As they continued demanding physical delivery against futures contracts, COMEX registered silver inventories declined from approximately 120 million ounces to under 40 million ounces. This inventory depletion exposed the fractional nature of the futures market. Physical buyers in the Middle East, Asia, and Europe, recognizing the emerging shortage, began paying substantial premiums over COMEX prices to secure guaranteed delivery of actual metal. The paper price, no longer credible as a true reflection of physical availability, began rising rapidly. From approximately $6 per ounce in January 1979, silver accelerated to $49.45 by January 1980, a 724% gain in just 12 months. The short squeeze forced numerous commercial shorts to cover positions at catastrophic losses. The price spike lasted roughly 4 months before the COMEX, in coordination with the CFTC, changed margin requirements and implemented position limits that effectively broke the squeeze by making it financially impossible for the Hunts to maintain their positions. But the key lesson was demonstrated. When physical delivery pressure exposes the fractional reserve nature of the futures market, price can move exponentially in a very short time frame. Both historical episodes share common structural features with the current silver market. First, the suppression operated successfully for extended periods, 7 years for the London Gold Pool, roughly a decade of $4, $6 silver before the Hunt squeeze. Current silver suppression has operated for over a decade since the 2011 peak. Second, the break came suddenly rather than gradually. In both cases, prices doubled, tripled, or increased by orders of magnitude within months once the suppression mechanism failed. Third, the catalyst in both cases was physical delivery demand that exhausted the available supply backing the paper pricing mechanism. Paper claims can be created infinitely, but physical metal is finite. When holders demand physical over cash settlement, fractional systems break. The current setup exhibits all the same structural characteristics. The COMEX has operated with expanding leverage ratios for over a decade. Registered inventory has been in continuous decline for 3 years. Physical premiums have been elevated for 22 consecutive months. Backwardation is appearing intermittently. The stress is visible and measurable in the data. History strongly suggests that when these conditions mature, the break will not be gradual and orderly. It will be sudden, violent, and will catch the market structurally unprepared. The mainstream financial narrative attributes elevated silver premiums to strong retail demand or temporary supply chain disruptions. Both explanations contain elements of truth, but fundamentally miss the structural cause. The paper futures pricing mechanism has become disconnected from physical metal reality, and this divergence is widening systematically rather than correcting. The COMEX futures price is set primarily by large institutional participants trading contracts that settle 98% of the time in cash rather than physical delivery. The physical premium is set by actual buyers, industrial users, mints, investors, and dealers who require possession of real metal and are willing to pay whatever premium is necessary to obtain it. These are functionally two different markets operating on entirely different principles. One is a financial derivatives market. The other is a physical commodity market. They are theoretically supposed to remain linked through arbitrage, but that arbitrage mechanism is breaking down due to refining capacity constraints, delivery time lags, and most critically, the unwillingness of concentrated short sellers to deliver physical metal even when economic incentives theoretically suggest they should. Second-order effects are already emerging but remain largely unreported in mainstream financial media. Sovereign and private mints globally have implemented rationing systems. The U.S. Mint, Royal Canadian Mint, Perth Mint, and numerous private mints have all instituted allocation systems, where dealers and distributors receive only a percentage of their requested inventory. This rationing has persisted not for weeks, but for months, indicating sustained structural shortage rather than temporary disruption. Industrial users are increasingly bypassing the spot market entirely, instead negotiating multi-year fixed-price supply contracts directly with mining companies. These bilateral contracts remove transparency from the market, creating a two-tier structure. Financial participants trading paper derivatives on exchanges, and physical industrial users securing supply through private negotiations whose terms and prices are not publicly disclosed. This bifurcation reduces overall market transparency and makes true price discovery even more difficult. The incentive structure driving suppression is institutional rather than conspiratorial. The commercial banks holding large concentrated short positions are simultaneously the designated market makers who profit from trading volume and bid-ask spreads. These institutions don't profit if the market becomes illiquid or if extreme volatility drives participants away. Their business model incentivizes maintaining the status quo, stable, range-bound prices that generate consistent trading volume with minimal delivery requests. Sharp price increases would attract speculative long positions, potentially trigger increased delivery demands, and create the risk that shorts would be forced to cover positions at substantial losses. The bank's profit-maximizing strategy is to prevent significant price discovery, not to facilitate it. This doesn't require a criminal conspiracy or secret coordination. It emerges naturally from the structure of incentives inherent in the market-making business model when combined with concentrated position holding. Regulatory agencies face parallel incentive distortions. The Commodity Futures Trading Commission oversees the COMEX and is officially tasked with ensuring fair and orderly commodity markets. However, if the CFTC were to publicly acknowledge that the silver futures market operates with fractional reserves and is structurally vulnerable to a delivery squeeze, confidence in the exchange would erode. Trading participants would migrate to physical-only markets, exchange trading volume would decline, and the regulatory agency's relevance and jurisdiction would diminish. The CFTC's institutional incentive is to maintain the perception of market functionality and integrity rather than to expose structural fragility. The agency has conducted investigations into silver market manipulation, most notably the multi-year investigation into J.P. Morgan Chase's silver trading practices that resulted in a $920 million settlement in September 2020 for spoofing and manipulation. But the core structural issues, the 25-to-1 leverage ratio, the concentration of short positions among 4 entities, the systematic divergence between paper and physical prices, have not been meaningfully addressed through regulatory action. Mainstream financial media largely ignores this dynamic because acknowledging it forces a series of uncomfortable systemic questions. If the COMEX silver price doesn't reflect physical scarcity, what exactly does it reflect? If the largest commercial banks are structurally short and unable to deliver against their positions, is the market legitimate? If the pricing mechanism is fundamentally compromised, what does that imply about other commodity markets, other futures exchanges, other financial instruments where paper claims vastly exceed underlying physical assets? These questions extend beyond silver to the structural legitimacy of modern, financialized commodity markets, and potentially to the derivatives complex more broadly. The implications are systemic and potentially destabilizing, so the analytical focus remains confined to safer topics: industrial demand forecasts, mine production estimates, technical chart patterns, and seasonal trading tendencies. The structural distortion is simply not discussed. What most people fundamentally miss is that price suppression doesn't require an explicit conspiracy or coordinated manipulation scheme. It emerges organically from the structure of the system itself. When futures markets are designed to settle predominantly in cash rather than physical delivery, when leverage is effectively unregulated, when a small number of large participants can hold massive concentrated short positions, and when regulatory agencies are institutionally incentivized toward maintaining stability and confidence over transparency and truth, suppression occurs naturally as an emergent property of the system design. The structure itself produces the outcome without requiring any explicit coordination or conspiracy among participants. When physical premiums remain elevated 22 months while futures stay range-bound, signal isn't about silver. It's about fragility of markets, where paper vastly exceeds physical. Same structure exists in gold, LBMA, unallocated claims, 3 unaltered X allocated holdings, crude oil, futures, open interest, multiples of daily production. Every commodity where financial participants trade without delivery intent. Broader implication, price discovery breaking. Prices should signal scarcity, tarsh abundance, directing capital efficiently. When suppressed below scarcity, signal fails. Producers receive insufficient revenue to expand supply. Investors allocate to overvalued assets, away from undervalued. Misallocation compounds until unsustainable, corrects violently. What breaks first? Confidence in paper market. When participants realize paper physical possession, behavior changes. Demand delivery over cash settlement. Shift to allocated accounts, physical storage. Industrial users secure supply outside exchanges. Each shift reduces paper liquidity, increases volatility, drives more exits. Feedback accelerates. History shows physical rejection of paper pricing isn't orderly. 1968, gold pool didn't gradually raise price, collapsed, price spiked. 1980, silver didn't trend higher over months, doubled in weeks. Mechanism nonlinear because leverage structural. At 25.8 to 1 leverage, 5% delivery increase becomes 129% physical demand increase. System can't absorb without repricing. Warning about aftermath. When silver, or any commodity, dislocates from suppression breaking affects spread. Industries dependent on stable inputs face margin compression. Institutions holding shorts face losses. ETFs promising physical backing, but operating fractionally face redemption crises. Ripples extend beyond commodity to institutions depending on suppression remaining functional. Silver trades at $31.85 as of February 5th, 2026, 35.6% below 1980 nominal peak, 83.6% below inflation adjusted. Every fundamental suggests multiples higher. Mine supply flat, industrial demand growing 9-14% annually, investment surging, deficit met by inventory drawdowns. Yet price remains range-bound. Explanation isn't weak demand. It's fractional reserve paper market at 25.8 to 1 leverage, where concentrated short holders supply contracts preventing price discovery. Divergence measurable. Retail premiums 31 to 39% above spot. Shanghai premium 215 to 85. COMEX registered inventory down 18.2% in 5 weeks. Backwardation appearing. U.S. mint rationing despite maximum capacity. Not signs of balanced market. Signs of suppressed pricing and physical tightness. History shows pattern doesn't persist indefinitely. London Gold Pool suppressed 7 years before 1968 collapse. Hunt Brothers exposed fractional silver in 1979. Price went $6 to $49 in 12 months. Both sustained suppression, then sudden violent adjustment when physical delivery overwhelmed paper capacity. Current structure more fragile, leverage higher, short concentration greater, industrial demand more inelastic. Policy tools. Breaking prior squeezes, COMEX margin changes, less viable in market where pension funds, ETFs, sovereigns hold large positions. Mechanism holding price below fundamental value for over decades shows cracks. Question isn't whether it breaks, it's when, and whether institutions, depending on stability, are prepared for repricing.